Namaste, investors. We at SmartSync strongly believe that the best way to become a better investor is to learn from other investors who have a strong past track record. In fact, हम सबने कहीं ना कहीं अपनी इन्वेस्टिंग लाइफ में वॉरेन बफेट, चार्ली मंगर, अश्वत्थ दामोदरम जैसे कई इन्वेस्टर्स के ब्लॉग्स, लेटर्स और इंटरव्यूज सुने हैं और उनसे लर्न करने की काफी ट्राई करी है। बट ऐसे काफी सारे इन्वेस्टर्स हैं, स्पेशली इंडियन मार्केट में, जो नॉट ओनली बहुत ज्यादा रिलेटेबल है, बट उनका पास्ट ट्रैक रिकॉर्ड बाकी सब इन्वेस्टर्स की तरह ही काफी अच्छा रह चुका है, इफ नॉट बेटर। बट सिंस वो पब्लिक लाइमलाइट में नहीं आते, तो उनके इन्वेस्टिंग जो लेसन है वो हमको मिल नहीं पाते। इसलिए हम इन्वेस्टिंग कारवा के थ्रू ऐसे कई इन्वेस्टर्स को लाने की ट्राई कर रहे हैं अपने प्लेटफॉर्म में, जिनसे हम उनके इन्वेस्टिंग फ्रेमवर्क, उनके थॉट प्रोसेस, उनके पास्ट में क्या लर्निंग्स रह चुके हैं एंड आगे वो कैसे मार्केट को देखते हैं, वो सीखने की ट्राई करें। सो उनमें से ही एक अच्छे इन्वेस्टर है मिस्टर विकास कस्तूरी जी, एंड उनके साथ हमने रिसेंटली एक पॉडकास्ट करा था। उसका रिकॉर्डिंग हम अभी अपलोड कर रहे हैं। सो एंजॉय द सेशन। थैंक यू।
Hello, everyone. Welcome to the 17th Mission Smile Investing Carva. This is Ankit Kanodia from SmartSync Services. SmartSync Services is a SEBI registered investment advisory firm. And Mission Smile, for people who have joined in for the first time or who will probably watch the recording for the first time, Mission Smile stands for making new stock market investors learn it through engaging research. I'm really happy to share with you that on our 17th podcast of Investing Karwa, we have with us a very dear friend of mine, Vikas Kasturi. I think I know Vikas since 2018. He was introduced to me by a common friend of ours, whose name is Anshul Khare. And I'm very, very, very fortunate to have met him because many of my investing ideas or maybe thinking or process has in some ways been influenced by Vikas. And I am 100% sure that today's session will be very, very, very interesting and you all will get a lot to learn because I know him very closely and I have learned a lot from him. So I'll not give a detailed introduction of Vikas. Vikas has been doing investing for close to a decade now, and he is an engineer. He keeps a very low profile. He is not on Twitter. He has a LinkedIn profile, but I think the most active you can find Vikas is on his blog post. So his blog post is interest upon interest. If you can just type in on Google, interest upon interest plus Vikas Kasturi, you will get to know his blog. And he has written more than 100 blog posts on investing. And I find them very, very, very useful. But Vikas, before I hand it over to you, I thought I will request Anshul to say a few words about you. Anshul, can you just raise your hand so that I can unmute you and you can... Yeah, great. So I'll just unmute you. Yeah, Anshul, you can go ahead.
Hi, Ankit. Hi, Vikas.
Hi, Anshul.
So I'm very happy to introduce Vikas to the audience. And let me first start by, so I've known Vikas for almost more than 8 years now. I think I met him first time in 2015. And what I clearly remember my first meet is that we had probably had attended an investor meet. There were 10, 15 people sitting there sharing their investment insights, and maybe we were sharing up one mistakes. So everybody was asked to share one mistake, one investment mistake. And as everybody shared that, I invested in this, lost this much money, and the price went down. And when that turn came for Vikas, he said, my biggest investment mistake was a 7-bagger. And it's like we were taken aback. I mean, why would you call a 7-bagger as an investment mistake? And from that point, it was clear that, the way Vikas used to think. Of course, after that, I've been in touch with Vikas. I've learned immensely from him. One of the things which I really love about Vikas is his passion for learning and teaching. He always has one teaching project going on. Sometimes he's some distant cousin sitting in Dubai, whom he's teaching investing. Sometimes he's engaging with people in his office, in his co-working space, talking to different people and exchanging ideas. And of course, his blog is a testament to the fact that how clearly he thinks about what he's learning, his investment process, his general, the way he looks at the world. So I personally have benefited immensely from Vikas, and whatever one or two multi-bagger I've had in my portfolio, all credit goes to Vikas. So all I can say is please pay close attention to whatever Vikas has to say today. He's, I mean, you can learn a lot from him. So that's all I want to say. Thank you, Vikas, for, for being there for us to learn from you. And I think Ankit would also agree with what I have to say. So.
Thank you. Thank you so much, Anshul, for taking time. Yeah. And before I hand it over to Vikas, I just forgot to mention one thing. There is a Tamil Nadu Investor Association 2020 meet, which is going to be held on 17th of February this month. Vikas is one of the 20 speakers. So many of us don't even know that he is a speaker there. That is the kind of low profile he has always maintained. And the reason, and there is a real reason for having that low profile and staying away from the limelight and staying away from social media, is that he wants to concentrate more and more in perfecting his art, which is investing. And I am 100% sure that it will be a very, very, very enriching session. So Vikas, before I go to the Q&A, you can probably start with a opening remark and then we'll straight away go to the question. Thank you once again, Vikas.
Thank you. Thank you, Anshul. It was quite a surprise. I didn't know you were going to join today. So thank you, Anshul. And so thank you, Ankit, for inviting me to your platform today. There have been so many people whom I consider as my gurus, like Professor Bakshi, Vishal Khandelwal, Gaurav Sood was here, right? So these are people from whom I have learned a lot. In fact, you would not believe, so I have watched Gaurav Sood's IIC video at least 10 to 12 times on special situation investing. So you had some great speakers here on your platform, and now you invited me. In fact, I even asked you, are you sure you want to invite me? So thank you for this opportunity, okay. And so I want to say, so my daughter, when she was in second grade, right? So she was full of confidence and she would say, I know everything, right? And I would ask her, is there anything you don't know? And she would say, no, I know everything, right? So if you see me speaking with that kind of confidence, right? So just forgive me as if you would forgive a second grade child. So I will just share whatever I know. And so along the way, I had made some notes on what I might want to cover, right? So we'll cover that during the Q&A. So thank you for this opportunity.
Thanks, Vikas. I'll not waste any more time. I'll straight away start with the first question. So Vikas, I know your journey because I being your friend for so long now, but for the benefit of everybody, please walk us through your journey from school days all the way to your MBA and how you came to be an investor.
So, so Ankit, I grew up here in Bangalore. So I did my engineering from BITS Pilani. So, so towards the towards the end of high school, right, I kind of got serious with academics, and I got good marks also in 12th standard. That's how I got into BITS, and so then I did my engineering from BITS, and then so I passed out in 2001. And at that time, the dot-com bust had just happened, right? So, so even the one job offer I had was taken away, right? They said, we are shutting down the company, so we don't have a job offer. And I had written CAT in December of 2000, and I didn't get into IIM Lucknow. Okay, I thought my interview went well, but I didn't get it. And I had one only offer, the admission offer I had was from MDI. So I was like not in the mood to join, but it was like beggars can't be choosers. So I didn't have much too many other choices. So I joined MDI Gurgaon, and so as things would have it, right? So I was very interested in marketing, right? And I had a roommate in MDI, and he was interested in finance. And he told me there is this person who's coming to teach finance, and you have to attend this one. I said, I did so badly in accounts. I don't even understand accounts. This is pointless me attending this. So he told me, at least take it as an elective, right? So DB mil gaya to kya farak padta hai, elective. So and that happened to be Professor Sanjay Bakshi, right? But he was a very different investor back then. He was into more like Ben Graham kind of investor. So he would. So you needed to be good at accounts to be able to understand what he was teaching, right? And like I said, my accounts was no good, and I did not get much out of it. Except that I said, okay, there is somebody like Warren Buffett. Uh, there is a Warren Buffett, and someday it would be helpful to go back and see what this person is doing. So soon after that, I joined work at Infosys, and so many years passed. So passed out in 2003, and so in 2015, I took a sabbatical from work. Right, I said I want a 3-month break, and so I took a sabbatical from work, and that's when I read all letters to shareholders by Warren Buffett. Right? And that's when I had a light bulb moment. I said, Acha, compound interest is the eighth wonder of the world, and it is something that you can make it work for you. And so that was the revelation. So to me, even though Professor Bakshi was, I came across him much very early in life, I did not, I did not make the best use of it. Right. So it was only in 2015 when I read the Buffett letters, I had a light bulb moment, and I decided that I want to become an investor. Right. And again, 2-3 different forces acting together. How randomness plays a part in your life. So my career, I felt, was not really going anywhere at Infosys. We were trying to build many software products, and one after another they kept failing. For software products have a high mortality, so for every one that succeeds, maybe hundreds of them fail. Right? So there were many of these failures, and I kept moving from one product to another, and so I felt like I'm not like I don't feel like I'm contributing something, or I don't feel like my career is going somewhere. Right. So that was one. The second one was I had a bad boss, right, whom I didn't like working with, right. So I didn't want to work with him, and that was the thing. And the third was, of course, I had discovered Warren Buffett. So all these three things made me realize, okay, maybe I should take a little bit of a risk in my life and try to become a full-time investor. And I was dilly-dallying and thinking about it for a long time. And in fact, at that time, I was a regular reader of Safal Niveshan. And I had read a lot of Anshul's blogs, right? And in some blog, I think he mentioned he stays in Bangalore. So I actually emailed him, and I said, Anshul, I'd like to meet you sometime. And he was kind enough. And I was actually, believe it or not, Ankit, today in 2024, this might sound a little funny, but I was really nervous to meet Anshul. Anshul is such a friendly person, And I was so nervous to meet him. And I told him, Anshul, look, I want to, I'm thinking of becoming a full-time investor. And what do you think? And so on.
In fact, because I am nervous to meet him now, the way he has evolved over the years.
So Anshul framed it very differently for me. You know, Anshul has a very different way of looking at things, and he framed it very differently for me. And he listened to me very patiently, and he said, "Look, if you don't try, it is a bigger risk for you." Right? Till then, nobody had actually said that to me, that it would be a bigger risk if you don't try. Right? And I'm glad I kind of listened to Anshul, and so. Uh, so incidentally, today marks my completion of first 7 years of being a full-time investor. So I quit my job on 10th of February 2017, and today it is 10th of February 2024. Right? So I quit my job in 2017, and I became a full-time investor. And so Anshul introduced me to another friend, right? And so his name is PJ. And so I told PJ yesterday, I said, PJ, if anybody ever wrote a book on me, there would be many chapters about you and Anshul, right? So I have PJ's explicit approval to take his name as PJ, right? So then Anshul introduced me to PJ, and PJ was also had a job and he was an investor, and so he has helped me a lot in terms of how to think. So by the way, I just want to also mention this, right? So you are the average of the 5 people you hang around with, right? And at one point of time, Anshul, PJ, and I we used to hang around a lot, right? And these two guys are like voracious readers, right? You name a book and they've read it backwards, right? So you obviously, you want to become like them. When you have people like them in your life, you want to become like them. And I owe a debt of gratitude to both of them in my early days, because they set the bar for me. Right? I wanted to become more like them, read a lot of books, have ideas, discuss mental models, and so on. So I'm sorry, Ankit. So what is it? I started rambling a little bit, but let's come back to the question. You said, could you just come back to the question? Repeat the question for me.
The question was the same, as in, tell us about your journey. So yeah, I
Yeah.
think you fairly covered that. So
Yeah.
I just have one comment there, that most people come here and they would like to talk about their achievements and what they did well. But it takes a lot of guts when you say that you were not going anywhere in your job,
Yeah.
accepting that you had a bad boss. So all those things coming out in the open and accepting tells a lot about the kind of person you are.
Yeah.
So because I'll quickly jump to the next question, which is related to this question, which is for someone who was a working professional for over a decade, quitting it all together and starting a new uncertain journey of full-time investing. And as you said, today you have you have completed 7 years. But let's go back 7 years from today. I'm 100% sure that it was not easy.
Of course.
Just how it happened, what was going through your mind,
Yeah.
and who supported you. I think you alluded to what Anshul said at that time, but I'm sure there is more to it. So if you can elaborate on that.
Sure. Thanks, Ankit. So I remember on the 10th of February, right? I went home and I took a last look at my paycheck and I said, I'm not going to see this much money again for a long time. So it was a bit of so it was very difficult. Okay. So it was more psychological, because if you're earning some money and after that you go to zero, right? So you will think twice about having a cup of coffee, right? This happened to me as well, and I initially tried working from home, but my kids were smaller then, So, it was a lot of disturbance and so on. Then I started working from a co-working office, right? And it was not, like I said, psychological. It was not easy because when you're working in a, let's say, a multinational company like Infosys, the offices are of a certain quality, nice and clean and air conditioned and so on, right? And then I went to this co-working office, which is like kind of a little bit rundown, and then you realize, okay, you're paying to work here, right? Instead of getting paid to work, you're paying to use those facilities, and just making those mental shifts was little difficult. First few days, really scared because I was like, "What have you done?" One big part of your mind was like screaming and saying, "What have you done?" Right? Uh, and but I also knew by then that look, I'm not the kind of person who can work at an office for 5 days and then I will have the discipline to go look at annual reports for 2 days, right? Rest of the 2 days of the weekend. I didn't think I was that kind of a person, right? I can do only one thing, and I can't do this kind of half here, half there kind of a thing. So I wanted to uh, sorry, I wanted to focus fully on investing, and that's how it was. So the first few days were very difficult, but gradually the focus shifted to reading annual reports and so on, right? And so that was the process. Okay. I was like, in fact, I was to watch many YouTube videos on how to overcome fear, right? So so like I said, all my challenges were psychological, and getting over that was the problem for me.
Yeah, because you spoke about Anshul a little bit, but anybody else apart from Anshul who helped you take that plunge? Because at that time, it's not that you have been investing for more than a decade and then you started getting comfortable and then you quit your job. It
Right.
was, you were a beginner at that time.
Yes.
Then you took that kind of a decision. So, which is
Yeah.
not an easy thing to do, right?
Yeah. So Ankit, see, at home, my wife was a big support, right? We were a double, both of us are working, right? And then we went down to like, she working and I'm like starting this new thing. So obviously, so at home, she was a very big support. Uh, and then, like I also said, Anshul and DJ, right? Okay, so incidentally, I'll tell you something funny which happened. So in 2016, right? Vishal Khandelwal wrote a blog. I forgot what blog he wrote, and I had commented something about something to do with investing full time, right? And he wrote another blog. He said, "You've given me an idea, so I'll write another blog." So he wrote another blog on why you should not invest full time, something like that. Right? And at around the same time, I think it was D. Muthukumar, he wrote on Twitter saying that all this is like working full time is all overhyped and stuff like that, right? So I'm just saying that people that you look up to, right? In a way, everybody was not supportive like the way Anshul and PJ were, right? Uh, there were other senior investors also who advised me against doing something like this. So you can understand my nervousness where I was coming from. I said once there are people with a lot of experience are telling me not to do this, and here I am doing it. So I was very nervous at the beginning. Okay.
Right. So I'm just sharing the link of the blog post of Vishal at that time. It was why you must not quit your job to become a full-time investor.
Yeah, that was the one.
Yeah.
And he wrote it in connection after I wrote some comments on his previous blog.
Okay. Great. So so till now we have just got some understanding as to how Vikas entered the investing field. So now we'll start with the investing related questions. So Vikas, first up, what kind of early notions did you carry with you as an investor that you no longer carry today? I mean, any particular strategy or association bias or maybe authority bias? I'm asking this because when I started, I had a narrow vision of investing when I started off. When I look back, I think it was largely because of some authority bias. Did you face something similar?
Yes, Ankit. So, see, you please remember, see, when I read Buffett's letters, right? So he had shifted, he had become like a high quality companies. He would invest only in high quality businesses, which have a very high return on capital and which have moats around them, right? And around that time, even Professor Bakshi had pivoted from being a Graham kind of an investor to more like a Buffett kind of an investor, right? So he had also pivoted, and he was also writing a lot of blogs on investing in high quality businesses like Asian Paints, Thomas Coke, and there are a few more, Relaxo, right? So these are some of the things that he has written about, right? And so when you read them, and I thought that, look, should I spend 20 years like the way these people spend, and then come to the conclusion that high quality investing is the only way, or should I straight away go to high quality investing, right? So so I said, okay, I'll go straight away. I'll look for high quality businesses and invest in them, right? So my early notions were, since you asked the question, my early notion was, I thought this is the only way to invest, right? Looking for high quality businesses, like the ones that Pulak Prasad has mentioned in his book, right? So I straight away went to that kind of investment, right? So my early notion was, this is the only way to invest. Now I think this is one of the ways to invest, right? There are many different ways to invest, and now this is one of the ways to invest. And again, time horizons matter. If you want to invest in high quality businesses with this kind of moats, you should think of at least 10-20 years, and a lot can happen in those 10-20 years, right? So it's not easy. It looks easy from the outside, but it is not easy as you hold it, um, right? So should I talk about how I'm investing now? Okay, now how I think about it.
Yes, Vikas. No problem.
Okay. So now the way I invest is more like, I like cheap companies where there is some sort of a catalyst at play. So it is good and cheap, and then there is a catalyst which will give me the upside. So the good and cheap will protect my downside. So even if I'm wrong about the whole thesis, because it's a good company, I will not lose much money there. So heads, I don't lose much. But if the catalyst works out the way I think it can, then it will give me a upside, right? So this is sort of where I'm currently. Okay, that I want to invest in businesses which have this kind of a combination going on: good, cheap, and catalyst. Can I take some examples, Ankit?
Yeah, go ahead.
Okay. So it's only for educational purposes, not as an investment advice. See, for example, let's think of IEX, right? It's a fantastic business, right? It's a kind of a business where it can grow, but does not need capital to grow, right? I would urge everybody to read Warren Buffett's essay on the great, the good, and the gruesome, right? So IEX would be like a great business, right? You will find it only once in a lifetime kind of a business, because it provides an essential service, right? And it's at the end, at the core of it, it's a technology company, right? So therefore, it can scale. The volumes can go up even 10 times, but the cost will not go up 10 times. So and therefore, it has like this incredibly profit margins, as high as 60-70% net profit margin it has, right? And it's got this moat in the form of this network effect, right? So it's a fantastic business, right? Now, if you want to hold it for 10-20 years, it's very difficult because because of regulation, for example, right? Every now and then new regulations keep coming up, and uh, and so on, right? So it makes it kind of difficult to hold a business like IEX, right? It really tests you that way, right? Another example could be like Avas Financials, right? So Avas is another fantastic business because, like Costco, it's like a Costco kind of a model where as Avas scales up, right, it is able to pass on the benefits of that scale back to the customer, right, in the form of lower rates. It's another great business. But again, holding it for 10-20 years, nobody could have imagined that the original architect of the business, Mr. Sushil Agarwal, will have to leave the company, right? So, so great businesses, holding great businesses is kind of undervalued. And it's a little difficult to do that, is what I'm saying. Over 5 years, 10 years, it looks easy from the outside, but as you go through it, it will really test you. So instead of that, I still love great businesses, okay, but my current pivot where I'm right now is like I like good, cheap, and a catalyst. Um, so okay, I won't. Okay, so Ankit, should I talk about a previous example which went up many times, or should I talk about a current example?
No. So because I think current examples will be taking up in the subsequent questions.
Okay.
You can say a lot about your past, where how you started as, and I think Anshul mentioned about a 7-bagger which you thought was a mistake. So maybe you can share a little bit about that.
Oh, okay. So this is kind of easy. So this is way back in 2005. Okay. So Professor Sanjay Bakshi had a group, Yahoo group, for all his students, right? And so somebody, and this was in 2005, you didn't get access to annual reports in PDF form like the way you get it now and so on, right? And so some of his students would post like the way we have people posting on Value Picker and so on, right? That time we didn't have those forums, right? So people would post via email. And so somebody had posted on, there was a company called Donier Industries, okay? They make undergarments or something like that, right? And it was 2005. There was a bull run going on, and somebody had posted some notes on this company, right? And I bought it, and it went up 7x in like few months or about a year's time, right? And so when I said it was a mistake, the reason it was a mistake was did I do any research? No. Or should I have done more research? Yes. Should I have understood the company more? Yes. Should I have learned how to invest as a value investor? Answer is yes. So those were the mistakes that I did not. It opened my eyes to some of the possibilities, but I did not take them. So those were the mistakes at that time.
Yeah. So because you told us about your evolution. Earlier, you were only focused on quality. Now you look at cheap, good, and some catalyst.
Yeah.
Right. So now, if you can just throw some light on how your investing process has also evolved. When you invest only in quality, you would have looked at things completely differently. Now, when you say that you are investing in situations where you are looking for really cheap stocks, but you are also looking at that it's not very bad quality stock. It's good business, cheap. It's a cheap stock, and you are looking for a catalyst. So I'm sure investing process in both these kind of investing would be completely different.
Yes.
If you can share that with example, how do you go about researching and finding, and how do you position size, and So that would be very helpful.
Sure.
You can again take examples
Yeah,
from past
yeah.
and from current.
So, so for those of us who've read this book, Pulak Prasad's book on what I learned about investing from Darwin, right? So in that book, he gives one, in the first or second chapter, he talks about errors of commission and errors of omission, right? And I wrote a blog also about it, and I thought this was a very fascinating idea. So, see, errors of commission are mistakes that you do, right? You try many things and some of them will not work out. That is an errors of commission because you're committing an act. Errors of omission is things that you could have done but you did not do. So therefore you omitted it and hence it's called errors of omission. So what Pulak Prasad says in his book is, so if you try to minimize errors of commission, you will end up with errors of omission. Okay, so think of it like this. If you try to play too safe, right, then you will end up committing errors of omission, things that you could have done, right? And on the other hand, if you try to reduce errors of omission, you will end up with errors of commission, right? So it is like kind of joined at the hip. So either you, if you try to minimize commission, errors of commission, you'll end up with omission. If you try to minimize errors of omission, you'll end up with errors of commission. So when you are a high quality business investor like Pulak Prasad, right, you will try to, so he says, which error do you want to commit, right? So he says we are perfectly fine committing errors of omission, right? So he has certain filter criteria, and he's very clear that this is the narrow subset of companies I will invest in, and rest everything else I will not take a look at it, right? So he talks about turnarounds, he talks about multinational companies, etc., that he will not look at, right? So one example he gives is Eicher Motors. He said it was a turnaround, right? And therefore we decided not to invest in it. Hence that became an errors of omission, right? It went up 100 times and they missed out on it. So, so coming to this, right? So what is the big shift, Ankit? I would say the big shift is that when you are a high quality business investor, you will tend to be, you will tend to minimize errors of commission. So you will want to, for example, read 20 years of annual reports. You will want to read all the con calls. You will want to read, you will want to do all kinds of forensic checks on the company. You will want to speak to as many people as you can. So you are, what are you doing? You are trying to reduce your errors of commission. And the way you will do it is having many filters, right? So,
Can you give some example, Vikas, over here for errors of commission, or I'm not looking for errors of commission here. I'm looking for when you started up and when you wanted to make sure that you don't do those errors of commission.
Sure.
If you can give some examples for
I'll just come to that, Ankit. I'll come to that. So on the other hand, if you want to reduce errors of omission, right, you have to be willing to do something as crazy as you listen to one interview and you say, I'm going to buy this company, right? Because you're reducing errors of omission. And that's how my friend PJ thinks, right? So he's like, he listened to one interview of Mastech, right? I am giving a particular example. And he said, this is a business, the CEO said these things on the call. This is good enough for me. And he bought it at what, 500 rupees a share or something like that. And in a matter of time, it just went up to 3,000. So what I'm trying to say is that you said, what is the big shift? The big shift is going from, so saying that I will reduce errors of commission to saying that I will reduce errors of omission. So errors of commission, to reduce errors of commission, you will do all those things, Ankit. You will want to read, I'll give you an example. So I was researching on Indigo Airlines in 2018. Okay. So imagine the work that I did. I read all the con calls. They had 2015 or something, it got listed. So for 3 years worth of con calls I read, right? I read 1 or 2 books on airlines, right? And I spoke to at least a couple of people from the airline industry to get a sense of the business, right? You have to do this kind of work if you want to reduce the errors of commission, right? And errors of omission, you will have to take calls even when you have the kind of data that you have is kind of thin, but you still want to take a call on it, right? So you will want to reduce errors of omission, because what you omit might actually go up 20 times, 30 times, right? So if you want to reduce that, so you will have to take quick calls sometimes, and you should also be willing to. So people like Pulak Prasad, once they buy a company, they are unlikely to sell unless something drastic happens. But people like my friend PJ, they are willing to, if they make a mistake, they are willing to absolutely cut their losses and get out of it, right? So they are not wedded to the company that way, right? So, so errors of omission, you have to be quicker. Sometimes you will get more data, sometimes you'll get less data. You make a quick decision based on that. And then also exiting also can be a equally quick decision. Saying that, yeah, I made a mistake getting into it, now I'll get out of it.
So, because you gave the example of Indigo Airlines, where you did a lot of work, you read a couple of books, you read all the annual reports, you read all the con call. And then I'm sure now the style which you have changed, you would not go that deep, right? So now how you, if you can give another example from the current set of, again, there's no recommendation, but if you can help us understand, how do you find an idea now? How do you invest now? And what kind of things you look, and how do you read about those businesses? Do you read everything now or not?
Sure, Ankit. So, so now I look at something that is unpopular. Okay. So by unpopular, there is obviously, I'll take a name, right? It will just shock a lot of people that you want to invest in a company like this. So take the example of Piramal Enterprises, right? So this is a company which went through a lot of pain in the last 5 years, right? They had made a lot of mistakes in the business, right? They lent too much too fast. Then they went into wholesale lending. They gave out big loans to developers, right? And when the real estate cycle turned worse, they were hit, right? And they had to do some distress selling and stuff like that, right? So this is a business which went from 100 or 150 rupees. Professor Bakshi wrote in 2011, I think 100, I don't remember what price it was. It went up all the way to 2000 something, and today it is less than half of that price, right? So, and even recent, there were regulatory things. Government said if you have an AIF, you have to make a lot of provisions, etc., etc. Right? So, so now this is a very unpopular idea, right? If I discuss this with a few friends, everybody is saying, you know, what's wrong with you, right? But so it is. So first of all, you think of it this way. It is still available at a price to earnings of 5 times, right? So it is reasonably cheap, right? And inherently, the reason I say it's good is because the person running it was one of India's great capital allocators once upon a time, and today nobody even calls him a capital allocator, right? So it's not like he made some mistakes. Ajay Piramal made some mistakes, but I think when a person admits he made some mistakes, he's likely to correct them, and I think he can still turn around this business, and they are turning it around. And the third part is the catalyst. So the catalyst is the loan book is changing, right? The mix is changing towards more retail, more granularized. They are either selling or they are writing off the old book, right? And while all these regulatory things are happening, so quarter after quarter you will see losses, right? But actually the cleanup is happening, and but nobody is paying attention to the cleanup, and that is why you are getting it at 5 times earnings. And if you go back in time and see IDFC First Bank, also quarter after quarter they were posting losses because of provisions, right? But but the change was happening every quarter. It was changing more towards retail, and the same thing is happening in Piramal also, right? So you want something that's good, you want something that is cheap, and because it is cheap, it is unpopular, right? And then you want a catalyst, which is in this case, it is the loan book changing, and there is a new set of guys running the business now. So you have all these things happening, and so that is the reason I would bet on something like this now, which will of course not pass. Nobody will call it quality. I will not get any mention by Pulak Prasad or Nalanda or anybody, because it will not pass their filters. But this is the kind of thing that I'm experimenting with right now.
No, so because my question was related to this, that what will you study in something like pyramid? How do you go about researching? So do you go and read all the 20 years balance sheet and annual reports? Do you go and read all the con calls, or how do you go about it today? That is my question. Yeah.
Sure. So, Ankit, so you will have to read first. You have to find out what is the crucial 3-4 things that need to happen for this story to play out, right? Or you look at the crucial 3-4 things that. So think about it. Think about how they used to borrow before 2018 and how they changed, right? For example, in the case of Pyramid, they had a lot of short-term borrowings, right? And when IL&FS crisis happened, what happened was they had to make these short-term borrowings, whatever they had borrowed, they have to repay, but they're not getting any new short-term borrowings. So that became a big problem for the company, right? So what would I study? I would go back and see what was their liability mix like in 2016, 17, 18, and what is it now, right? I would go and see what was their loan book composition then and what is it now, right? I would also probably see who are the people running the show then and who are the people running the show now. So once you identify these 3-4 things that are most crucial for the story, you go and research those things, right? I'm not like I will not go all the way to 2005-6. That is not relevant to what I'm trying to do now. I want to identify those 3-4 things that are most critical, and I will go and find information about that. That is what I would do. That is the change here. Okay. So, like I said, I would go read the books on airlines and stuff like that. I might not do the same thing in the case of Pyramid.
Yeah, so because I have a follow-up to that, you've explained it wonderfully. So even though, as you say that now you're not looking like Warren Buffett or looking like or trying to find the best quality businesses available around, but there is some truth in what Warren Buffett says, that turnaround seldom turns, right? So increasingly, it is very difficult to find. Of course, right now we are in a bull market, and many things are happening, which makes us believe that there is a lot of returns can be made in turnarounds. But if I want to understand that you are trying to bet on turnarounds, the turnaround could take any kind of shape, but it is basically turnaround. But when we look at the base rate of turnarounds, right? So it is not so great, right? There is some truth in that. So how do you counter that and make sure that your downside is protected there?
So a couple of things, Ankit. So one is I rely on numbers, right? So when we say turnaround, right? I just made some notes here. So one is let's be very clear, okay? So one is there is a balance sheet. Let's say it's changing, right? So Rohit was here on this show, right? He explained how Sangvi Movers was turning around, right? You could see that, like let's say quarter after quarter, or let's say every 6 months, or even every year, you could see that the company was taking all the profits and and reducing debt, right? So you could see that balance sheet is getting cleaned up, right? So that is one example. Another example could be like product mix is changing, right? So in the case of IDFC First Bank, again, every quarter he was posting that, for example, I think when they started, they had 75% wholesale, 25% retail. But every quarter, the 25 became little more, right? So 25 became 30, 35, 40, 45. So it was changing. And they also posted saying that we are opening so many branches and so on, right? So, so product mix is changing. That is the second example. The third could be like a management change, right? So somebody from the industry comes and changes the business, right? He's come in, and therefore you should watch this more carefully. Fourth is like there's a regulation change. So, for example, in the case of Suzlon, the government changed the process of how wind power is going to be procured. Right, between 2017 and 23, they have introduced this e-reverse bidding, right? And it was the death knell for all the wind power guys, right? Because everybody was like out competing, and therefore they bid at prices which were not sustainable. So then they said we will make only the wind guys compete against themselves. So that was the e-reverse bidding they scrapped. So in the case of Suzlon, I had one more example. I forgot that. So these are companies which are benefiting because of some regulation change, right? And so that could also be a example for change. So yes, turnarounds rarely turn. I can't argue against profit. Okay. But what I'm trying to do is like I try to look for numbers where the turnaround has already started happening. I'm not trying to capture all 100%. Okay. First 10, 20% I will miss. By the time I come to the story, I've missed the first 10, 20%. But then you start seeing the numbers increasing and management doing the right things. And then you start, then it's a question of belief, right? Then you believe that the momentum can continue. I'll give you one more example, Ankit. So this is of Repco Home Finance, right? So they had a terrible thing exactly 2 years ago in FY22. Their NPS hit as high as 7%. Okay. Then a new CEO comes in. Okay. So the new CEO, he has not done anything extra, no extraordinary ideas, but the execution has been extraordinary. So he has, so imagine that there is a water tank and there is a water in it. Now, if I take out more water and than I put into it, right, then what will happen to the water level? It will go down because I'm taking more out of it than I'm adding, right? So he's done pretty much the same thing with the NPAs. He has every quarter he has recovered more from that NPA pool than he's added into it. You can see this for 6-7 quarters. He's done this in a row, right? And he's done the vice versa opposite when it comes to the AUM loan growth, right? If I'm losing less customers to banks, right? If I'm stopping that, and at the same time I keep adding more to the loan book, then the loan book will start growing, right? So that is the other thing which he has done. So just these simple things of growing the loan book, reducing the NPAs, right? You can see it in quarter after quarter after quarter. So if you see such things happening, I would like to take a position in it. And so yeah, turnarounds rarely turn, but when I see the momentum already playing business momentum in that direction, I will bet on it.
Yeah, fair enough, because so I think somebody asked this on the chat box as well, and I think this is the right time to ask you this question. Arun asked this question, and I was having the same question in my mind, so I'll ask this to you. So now help us with your position sizing when you are betting on these turnarounds, or increasingly you are looking for businesses. And before I go to the question, I think if I summarize it, what you have said for everyone. One you look for is a very cheap price. And the second thing is you don't want to bet early. You want it to, that turnaround process should give you some evidence first before you jump in, rather than trying to speculate that there will be turnaround, right? So these two are the main tenets on which you are investing rest. So now the next question is, how do you position size your positions? How many positions are there? How do you scale up? How do you scale down? If you can take us through that, that would be very helpful.
So Ankit, this is also work in progress as far as I don't have a very good answer, and this is something that I need to improve on, Ankit. So so Rohit was here on your platform, right? So he told me that I am like little scared, right? So I might say all these things about all these turnarounds and this, but when it comes to position sizing, I actually start very small, right? Because of the same things. You will feel like, oh, Mr. Buffett has said turnarounds rarely turn, and here you are going against his advice and betting on turnarounds. right? So that scares me. So I'm a very scared investor, timid investor I am. So my positions, I start small, and then with passing quarters I keep adding more, right? Uh, but Rohit was like, he challenged me. He said like, why don't you try and take a bigger position, right? So full disclaimer, I have a position in Repco Home Finance. So in that case, I have taken a bigger position, right? Because this is like, um, he's like challenging me, saying that if you have so much conviction in this idea, then you should be willing to bet more. And therefore, I have uh, tried to do that here. Okay. So I start small. I start with like 1, 2, 3% kind of a thing, and with in normal scenarios, not like this bull run, but in normal kind of scenarios, I start small and then I keep adding every quarter, right? But with Repco, I made a exception of buying in larger quantities.
Larger means if you can.
So it would be about 6-7% of my portfolio.
And what is the highest you have gone till now in your allocation in terms of one stock?
10% maybe, Ankit.
Okay. And roughly, what is the total number of stocks you have?
I would have about 30 stocks.
30, but I think 10 or 15 would be.
Yes,
about
yes.
18,
Top 10 would account for about 70%,
Okay.
and
Then
then there is a long tail.
Great, great. So that
So
was
like I said, Ankit, I'm work in progress here. I have not given too much thought here. So it is like this, right? So when you start to play cricket, right? Let's say you are just starting, let's say you are the newest recruit in the Indian cricket team, right? So shuru mein your focus will be on like, acha, I don't want to get out, right? I want to score some runs. I don't want to get out, right? So मेरा अभी तक वैसा ही रहा है. It's only when with experience you'll say, if you're Virat Kohli, for example, who's played so much, you'll say, no, look, there will be patches when you have to think a little differently and try to score big runs at those patches when you're in a good form and so on, right? So that because that will kind of because you will hit a bad patch also. So the time to do well is, and then you want to play a little differently, and that's what Virat Kohli will teach you. So I'm still in that new wala phase. Okay.
However, because these days newcomers are fearless. They start hitting the ball right from the first go. So maybe we are a little old school, but that's okay.
Yeah. So a flaw of mine, Ankit, is that I'm a timid investor. So I like to play it very safe. I told you, right? Mr. Buffett is like, it's almost as if he's telling me, what are you doing? Like,
So like it reminds me of that quote, there are no old investors, there are old investors, there are bold investors, but there are no old bold investors.
Yeah.
Maybe that serves well now. So I'll move on to the next question, Vikas. So one aspect of your investing, which I have not touched upon in today's session yet, but actually I'll share the session's link. So we did a session with Vikas exactly a year back, maybe in Jan 2022 or 23 rather, where he did a deep dive on his special situation investing style. So now, Vikas, while I'll share the link of that session with everyone, if you can just share about your journey, your evolution, some mistakes which you might have made, and eventually you're learning from the whole journey and how you are using it today. So that would be very helpful.
Okay. So mistakes in general, right? Not just special situation.
No, I'm talking about special situation only right now. This question is related to special situation.
Okay.
You talk about your journey as a special situation investor, how it came about, how you started, when did you start, what happened, some notable experiences, some really good winners or good losers, and some main learnings.
Sure. So Ankit, I think it was 2018-19, December 2018 and Jan 2019. That's how those were the two first cases. So one was this company called Allsec, okay, and so this company was trading at I don't remember. I think it was at about 180 rupees, 188 rupees, around that much, and it had nearly 90 rupees of cash on its books, right? And it had one new product in HR payroll processing, I think, which was doing really well, right? So now this company was sitting on all this cash, and it wasn't paying out dividends or doing a buyback and none of those things, and it was available at a really, really cheap price, right? So this friend PJ and I, so we wanted to do a hostile takeover. Okay. Okay. So neither
Because
of us.
for the benefit of all, because there would be some new investors also, if you can just explain a little bit on what is hostile takeover, give a few example where you would have seen some
Sure.
big investors doing that, that will be very helpful. Yeah.
Yeah. So sure. So we wanted to. I'll tell you what is a hostile takeover. A hostile takeover is so outsiders, people who are not shareholders of the company, they want to take over the company. So they start buying shares of the company from the open market, build up a large position, then go to the management and say that either directly confront them, saying that you want to take over the company and you guys get out of the company, or you go and say that give us a seat on the board, and so that we also want to be part of all the key decisions, right? So hostile because you're hostile to the current management, right? And you think you can run the business better than the current management is running. So in 2019, for example, L&T did a hostile takeover of Mindtree, right? So the promoters of Mindtree only had about 20% ownership, and L&T managed to get more than 20% ownership. They bought some stake from, I think, VG Siddhartha and few others, and then they forced out the existing management of Mindtree, and then they acquired that company, right? So in India, we have not seen too many hostile takeovers. In the recent example, this is the one that comes to mind. I would urge everyone to watch this movie called Barbarians at the Gate. It's there on YouTube. Okay, it's a fantastic movie based on real life events, and so do watch that. You will understand what is a hostile takeover. So coming to this Allsec, so PJ and I, we wanted to do a hostile takeover. I mean, neither of us had that kind of money, but we thought we will get some investors to back us, so that we acquire, let's say, 30-40% of the company, and yeah, so 30-40% of the company, and we will try and force the management out, and we can. Okay, so the other thing was this company was selling at about 5 times earnings, and this company was selling at 5 times earnings, whereas other call center kind of businesses were selling at about 16 times earnings and so on. So the idea was really simple, that we will buy enough shares of the company, kick the management out. We will run the company, pay ourselves a big dividend, and we will dress up the company and sell it at 16 times earnings. Okay. So this was the plan, simple plan. Okay. So now we were at 180, 185 rupees per share. That was the trading price. And so I saw somebody ask this question. Yeah, like Carl Icahn. So I saw somebody ask this question. You call yourself a timid investor. How come you did this? So this was probably the boldest thing we thought of. Okay, now listen to what we did after this. So now we wanted to speak to the management, understand a little bit more about the business and so on. And for that, both of us bought one share each. Okay, just so that we can go to the investor relations and say that, look, we are shareholders and we want to speak to the CFO. So we spoke to the CFO, we got some information and we had some questions and so on. And after that, then what happened was we realized there is this Carlyle, they were invested in Allsec and they had 2 board seats. I actually tried reaching out to Carlyle, but obviously they didn't talk to us. Right? They didn't want to. We even tried to go and speak to a very senior investor based in Chennai. And I'll tell you that story also. But good that he didn't speak to us. Okay. And so by this time, we had given a reasonable amount of try speaking to investors, trying to tell them, please teach us how to do a hostile takeover. Are we thinking right? Are we thinking wrong? What are we doing? So we gave some reasonable effort, and then I started figuring out. Then the timidness part took over, and then it said, like, Jane do, I think whatever you're thinking is not right here. So you forget it. And we forgot about it. So both of us had 1 share each. So this was around Jan-Feb of 2019. So April 2019, just 2 months after we did all this work, Quest acquired Allsec for 320 rupees a share. So if we had bought more, we could have gotten a 80, 90 or 90, 100% kind of a return on our investment in just like three months, right? So that was like bittersweet, because at least sweet for me, because I felt like, okay, whatever you were thinking was not too bad, because there is value in this company at the end of the day. And it was bitter because we didn't buy any, we bought 1 share each, right? So that was our experience. So somebody asked, how do you call yourself a timid investor thinking about this? That timidness is the reason we did not do this whole hostile takeover, right? So, but that gave me some confidence, saying that, okay, whatever you're thinking is not way off. It is like kind of you're getting better at valuation and so on. So that gave me a lot of confidence. The second special situation that we actually participated was Prabhat Dairy. So Prabhat Dairy, so this business, the owner sold the dairy business to a French company, and they had another dairy company in India called Tirumala Dairy, I think. So they were selling the dairy business to Tirumala, and they were selling it at 1,700 crores, if I remember correctly, right? And they had 10 crore shares outstanding, which means they were going to get 170 rupees on completion of the deal. And we figured, okay, after paying taxes, this, you will have at least 100 rupees of cash per share. And that shares, because they announced this sale, the sentiment in the market had gone bad, and the price was trading at 48 rupees per share, right? So you could buy a share for 48 rupees. You will have at least 100 rupees of cash. And during the extraordinary general body meeting, they said that we will want to return a lot of this money back to shareholders and so on. So PJ and I, we actually bought in large quantities. I think even Anshul participated in that with us. We bought in reasonably large quantities. But by September, October, we realized that the management was not really they were not good people, and they were not really trustworthy. So we exited at around 80, 85 rupees per share. We exited, right? It was still a decent return on investment. And finally, in 2020, during COVID, sometime they delisted at about 100 rupees per share, right? So this was the start of the special situation journey, Ankit. Okay, and subsequently, I did few more special situations. But now, if you ask me, I will say that I like to do open offers. Where, let's say, company A is taking over company B, and therefore it has to make a special open offer to the shareholders of company B, right? And sometimes you will notice that company B's share is trading at X, and whereas the open offer is X plus Y, right? So these are some of the special situations I like to participate in now, right? I don't do so many of these other things. I mean, kind of busy with the other things, so don't have too much time to do special situations. But this is what these are the things that I'm doing right now. It's kind of limited now, Ankit. So yeah, so I just wanted to mention these two cases because at least for somebody with a lot of doubts, so suddenly some of these ideas played out, and that's what gave me a lot of confidence that I was not thinking, my thinking was not too way off.
Thanks, Vikas. That was very, very, very helpful. And I've shared the special situation session link of Vikas on the chat box. So if anybody is interested to know more about special situation, you can go through that link. Or anytime you can just on YouTube, you can just type SmartSync Services Vikas Kasturi special situation. You will get that video. Okay. So Vikas, I'll move on to the next question. So the next question is, now I'll come to the, you have spoken a little bit about your portfolio structure in terms of how do you position size and all. But this is a much more specific question where I'm asking you about the age-old debate of concentration versus diversification. And Munger and Buffett are big proponents of concentration, right? If I remember correctly, Munger has probably 4 or 5 stocks in his portfolio only. And Buffett also has a very concentrated portfolio. At least in his earlier days, he had far more concentrated portfolio. So, but there are many investors who have a diversified portfolio. So what are your thoughts? What appeals to you and why?
So Ankit, I think Professor Bakshi has already given a very good answer on this. He gave it at Flame University. I will just try and repeat his answers. If you think about in my last blog, which was on playing Russian roulette, right? In a Russian roulette, you, for those of you who are new to this metaphor, so in a Russian roulette, imagine there's a gun with 6 chambers. You put a bullet in one chamber, spin the chambers, and then load the gun back and put it to your forehead and shoot, right? So if you survive, you get $1 million, right? If you don't survive, of course, it doesn't matter. You're dead anyway, right? Now, this is a very, very powerful metaphor, in my opinion. And there is an entire book which Taleb has written called "Fooled by Randomness," right? This is such a powerful metaphor, in my opinion, because it just teaches you that don't do stupid things, right? Because just because, see, when let's say 10 people play Russian roulette, right? Obviously, the ones who survived, they will look brilliant, right? They will look like rich and successful, and they will also write books on how to play Russian roulette successfully and so on, right? So Professor Bakshi had a very interesting thing. He says, don't look at only the people who survive, because essentially you are playing a dangerous game. When you play a dangerous game, there will be some guys who survive and will look brilliant, right? But don't look at them, right? Look at the people who did not survive, right? And they did not survive because to start with, you were playing a really dangerous game and you were pretty dumb to play that game. So he said the same thing. He said that a concentrated portfolio is also, in a way, a dangerous game, right? Because there will be some guys who survive and make it big, um, um, right? With 3-stock portfolio, 4-stock portfolio. He said even Munger will, you will look at him and you will think that this is the way to do it, right? He says, but if you think from the point of view of safety, right? You should, if you think about it from the point of view of safety, you should have a reasonably diversified portfolio, right? I would not advise anybody to have a concentrated portfolio, because no matter what you think, right, there will always be some negative surprises, right? If you lose, like somebody said, right, if you lose 50% of your money, that means you now need a two-bagger just to go back to the same place, right? So, so my humble submission is like, don't go concentrated. It doesn't matter whether you're young or not young. It doesn't matter. Safety needs to come first, right? And uh, uh, so Anshul had written an entire blog on this, right? He said, imagine there is a race. I don't know if this is a joke or if it actually happened. Imagine there is a horse race, and then you saw there is only one horse in that race, and therefore you put all your money on that one horse, right? And instead of completing the race, the horse ran halfway and then jumped across the fence and ran away. It never completed the race, right? So don't be too sure about the outcomes, right? And so to me, concentration, shorting, all these are like dangerous games, and I would not advise anybody to be highly concentrated. That is just my 2 cents here, because these are dangerous games. Yeah, so coming to diversification, Ankit, so I think it should be reasonably diversified, that you don't put more than say 10-15% of your money in any one stock, because anything can happen.
Right. Thank you so much, Vikas. So I think somebody asked a very relevant question to this diversification and concentration topic. I'm forgetting who asked this question, but I'll anyway go ahead and ask this question to you. He or she asked that what about diversification in terms of different asset class? How are you diversified or concentrated in that way? Do you think equity is the asset class where you have a majority of your holding, and or how does it look like? If you can just share about your overall asset class diversification.
So, Ankit, I might not be the perfect example that way, right? Because before I became an investor, I also invested in real estate and so on, right? Because I used to think equity is very risky and so on. So my question was like, when you see whichever asset class, what if you say equity is, all your assets should be only in equity. My only question to you is like, ask yourself, like, what if you're wrong about it, right? So imagine in 2020 when we had the market crash because of COVID, right? And then after that, the governments together pumped in a lot of liquidity into the system, and so that businesses don't shut down, etc., etc. So this is one of the possible outcomes that could have happened, right? There could have been so many other outcomes, right? Would you have been okay if some of the other outcomes that played out? If you had put 100% of your money in equities, and let's say that went down to 50%, would you be okay with it, right? So my simple thing is like, don't just think about the upside, think also about the downside. And would you be okay financially, psychologically, or otherwise, right? If you lost 50-60% of your money, right? Again, if you're younger, you have years ahead to sort of recover. But if you are, let's say, in the middle, if you're in around 40s, 50s, 60s, and you lose 50% of your money, will you still be okay? Is the question, right? And so your answer will come from there, right? So my only thing is, so Ankit, I would think like, I always think about the downside. Like, if this goes down 50%, will I be okay? Will I still be able to stand on my feet?
Right. That was very helpful, Vikas. So now I'll move to my favorite question, because and it is about your blogs. So you have a wonderful blog by the name Interest Upon Interest. And I've shared one of the blog links already on the chat box, and I would urge everyone to just go and look at a few blogs, and I'm sure you will be hooked on. And you have written more than 100 blogs, Vikas, if I'm not wrong. And I can proudly say that there are only two people in the investing world whose blog posts I have read word by word, all of them. Some of the blogs I have read multiple times. One is Professor Sanjay Bakshi, whose blog is by the name Pandu Professor's blog, and I'm sure most of us are aware of it. And another is Vikas's Interest Upon Interest. While there are many favorites blogs of Vikas, and one session will be too little to discuss my favorite blogs of Vikas, I have handpicked two of them, as I believe they would be very relevant for all of us today. So one is a series of blogs on the topic of Extremistan versus Mediocristan, highlighting your love for non-linearity. And the second one is a series on cash flow. So I would like you to expand both of them one by one. So we can probably start with Extremistan versus Mediocristan.
Thank you, Ankit. So friends, so Nassim Taleb has written several great books, right? Probably his most famous one is The Black Swan. And in The Black Swan, there is a essay that he's written on Extremistan and Mediocristan. Okay, so these are names that Taleb has created. So he says in Extremistan, you have extreme results, right? Where one or two people or one or two winners will take away all the let's say the profits of the industry, or one or two. It's a place where winner takes all, right? And in Mediocristan, while you will have several giants and several dwarfs, but there is no one winner who takes everything, right? Um, so this is a fascinating idea. Okay, Extremistan, Mediocristan. So you think about it, right? When you look at, let's say, if you could, okay, let me take the example. I think he himself has shared, Talib. So imagine there is a stadium, okay, and there are 1,000 people in the stadium, right? And now you take the average weight of that people in the stadium, right? And I can tell you straight away, it will be somewhere around, say, 75 kgs, 70 to 75 kgs, somewhere around that. You can be pretty sure about this, right? So if you substitute the lightest guy there with the heaviest guy, the heaviest man, let's say, is 400 kgs, right? And now what is the average of that? It would have gone from, say, 70 to 70.4. That's all, right? So this is an example of Mediocristan. Now imagine the same 1,000 people in the stadium, right? And you take out, and now you take their net worth, right? Average of their net worth. Okay. So let's say it comes to $100,000. Now you take out any one guy and you substitute him with the richest man. Let's say richest man is Jeff Bezos at 200 odd billion dollars, right? So now your average will go from $100,000 to 200 billion divided by 1,000, right? It will go to 200 billion straight away. I'm not even including the other 999, right? So the winner so the richest man in that stadium will account for 95% of the net worth of the entire stadium, right? Whereas in the first case, the heaviest man will not account for more than 0.4 or 1% of the weight of the stadium. The first is an example of Mediocristan. The second is an example of Extremistan. Now, this is a very fascinating topic, right? So in the world of business also, you will notice that there are certain domains where one or two winners will account for all the profits, all the market share, all the profits of that industry. And there will be many little players on the fringes, right? So take the example of if you put Google and Facebook together, they will account for say 90-95% of the ad revenues, right? So big monopolies. If you again, if you take Google and Facebook, they will account for most of the social media profits in the social media pool, right? But now you compare it with, let's say, IT services, where TCS, Infosys, Wipro, Cognizant, HCL, etc., etc. So many companies are there, right? And no one company can account for even 90% of the revenue or 90% of the profits, right? So these are companies which operate in Mediocristan, whereas Google, Facebook, if you take stock exchanges, NSE accounts for 90-95% of the equity market, right? BSE accounts for only 5%, right? So if you think like this, you will see that first of all, Extremistan is very rare to find, right? And within that, the opportunity to buy a business in Extremistan is even rarer, something that comes at a cheap valuation, right? So my whole thought process was that, so for example, go back to exactly 4 years ago when because of COVID crash, IEX was available at say $40 per share, right? Something like that, right? So you can see that this is a business that operates in Extremistan. This is a business that has 98 or 99% of the market share and more than 100% of the profit share, right, of the industry, and so on, right? So now that investing decision becomes so much simpler, simply because you understand the concept of Extremistan and Mediocristan. Uh, uh, so there are these businesses, most of them are in technology related, right? Uh, which operate in Extremistan. So housing finance companies, they all operate in Mediocristan, right? So if you start thinking about it, there are very few pockets where you will find Extremistan, and the ability to buy it at a cheap price, that is even rarer. So Extremistan is very rare. That is what I was trying to say on in that blog. And should I go to the cash flow statement?
Yeah, Vikas.
Okay. So so Ankit, you have done fantastic presentations on Mahindra Holidays, right? And that is a perfect example of how the profit and loss can be misleading, right? So so in the case of Mahindra Holidays, so this is a company that is able to take cash upfront from customers, right? The customers upfront pay a 25-year membership, right? And they also pay upfront for the services that they are going to take in that particular year, right? So, but when it comes to the profit and loss statement, it will say that this is a business where um, the Indian accounting standard says that you can only recognize 1/25th of the revenues each year that you take upfront, because that is the revenue for 25 years. So you cannot take all 25 years revenue at one shot. You have to take only 1/25th every year. So, what will happen is the cost associated with acquiring that customer, that is getting apportioned most of it in that particular year itself, right? So your cost is, let's say, 100%, but your revenue is 4%, right? So when you look at the profit and loss, revenue minus cost, the profit will give you a sort of a wrong picture about the business, right? So even today, if you, I don't know what price to earnings it is going at, it will be somewhere around 60-70 times earnings. Why? Because the earnings is, what do you say, artificially lower. Okay. Oh, it's at 94 times. So the earnings is artificially lower, right? But if you were to open the cash flow statement and see, you will see that this is a business that is drowning in cash. They already have 1,000 crores sitting on the balance sheet, in addition to that, every year they are generating like 500, 600, 700 crores of cash, right? Upfront, more and more is getting added to it, right? So the cash, my point of writing the cash flow statement was that the whole world is focused on the P&L, right? And P&L tends to give you or doesn't give you the right picture all the time. And therefore, you should look at the cash flow statement. Okay. Cash flow statement is where you get the true picture of the business, right? A business which is giving you, if you were the sole owner of Club Mahindra, you would be like Uncle Scrooge, you know, you can like dive into money. It is like that kind of a business. You can have your private swimming pool where you have little coins and then you can dive into it. You will have so much money, right? So Club Mahindra, in my opinion, is that kind of a business. And so my whole point of writing that blog, Ankit, was to highlight that the profit and loss statement can be misleading. And in that one example, I had also given where a company is highly profitable, right? I think I've taken the example of GR Infra Projects. It was highly profitable if you look at the profit and loss. But it is like the opposite. It is like they are like they don't have cash to run the business. They're running out of cash because a lot of money is stuck with the government, right, in the form of receivables. So I was trying to say that you should look at businesses like Club Mahindra and avoid businesses like GR Infra. Yeah, Ankit, if you scroll down, you will see
there
the
is
profit
no,
growth.
yeah, there is no recommendation here, but you can just look at the profit and loss statement here. The profits are rising phenomenally from, say, it was 35 crore in 2014, and it is 1400 crores in the last accounting year.
Yeah,
But
and if you
now,
see the profit growth, you can see that also, right? Compounded profit growth.
yeah, you can see the compounded profit growth. In the last 5 years, it is 29%. Now let's come to the cash flow statement. So out of 1500 crores of profit, only 184 crore has been converted into operating cash. So that tells a lot about the inability of business to generate cash.
And if you, so the other thing is you want to add up at least 4 or 5 years of cash flows so that 1 year will not move the needle this way, that way. If you add up 5 years profits and compare it with 5 years of cash flows, you will see that the conversion ratio is very, very bad in this business.
Yeah. So it's difficult to explain everything on this session, but I think it would do a world of good to all of you if you can just read those blogs which Vikas has written, because there he has further deep dived on all these finer nuances of cash flow statements. So he's given multiple examples where there is good cash flow but bad accounting profit, or there is good accounting profit or bad cash flow generation. So that will give you a very good understanding. So thank you so much, Vikas, for
Thank you. Okay.
writing them and expanding on them now. So because now I'm going to ask a tough one. So I know for you, all your blogs are special, but I need you to pick the top 3 blogs that you are proud of. It did not be investing related, because I know that a couple of your blogs are not investing related out of those 100 plus blogs. So which are the top 3 blogs as per you, which you would like me to share with the audience today?
So thank you, Ankit. Actually, this might sound surprising, but I don't read my own blogs. So once I publish them, I just make sure the grammatical errors and other errors are not there. But once I publish them, I don't read them. But I'll tell you, there was one blog I'd written. So financial inclusion is a topic that is very close to my heart. You know, stories about financial inclusion is something that really gets me going. When I see something like an Avas, for example, you know, the way they are, you know, so as Avas grows, for example, assuming they grow the way they were doing earlier, you can see that the whole society benefits around that, right? People who didn't have homes will get homes, and uh, as Awas scales, they'll get it at a lower rates and so on, right? So, so one idea is financial inclusion. The other idea is win-win, right? So everybody in the ecosystem also wins, right? So if you see, for example, tobacco companies or fast food companies, right? The whole premise is a win-lose kind of a thing. So company wins, but the consumer loses, right? In the sense, he's consuming something which is harmful, so he suffers, right? So there is a win-lose kind of a thing, and I don't like win-lose. I like win-win, right? So so like a Costco or Ravas or even DMart, for example, right? So everybody in that ecosystem of that company, everybody prospers, right? So I like a win-win kind of a thing. So in that aspect, I'll say my one blog on Akshay Kalpa, which has both financial inclusion as well as uh, what do you say, financial inclusion as well as win-win kind of a thing. I saw those kind of models in Akshay Kalpa. So that was one. And the other one would probably be the one I wrote on how Sushil Agarwal built Awas, right? So these would be two of my favorite.
Because would you like to make a disclosure on Awas right now?
Yeah. So friends, I used to own Awas. I no longer own Awas.
Thanks, Vikas. Yeah, because you spoke so highly about Sushil Agarwal and Awas Financials. I just wanted you to make this disclosure because some people might take it as a recommendation.
Yeah. Yeah.
Thank you so much. Yeah. So I'll share the blog one on Akshay Kalpa in a bit. So let's move on to the next question, Vikas. Thank you so much for all these answers till now.
So Ankit, can I just share something?
Yeah, sure.
Yeah. So in 2016, I had attended one course by Professor Bakshi at Flame University, right? So he had, I really like this idea that he spoke about, which is win-win. So he says that, and if you think about it, right, in a win-win kind of a ecosystem, all, whether it's your supplier, your employees, your customers, your shareholders, everybody wins, right? So in a win-win ecosystem, on the other hand, right, let's take the opposite example. Let's say there's a win-lose kind of a ecosystem, right? Where you're treating your customers well, but you treat your suppliers badly. You treat your shareholders well, but you treat your employees badly. So the ones where you treat badly is where the risk will come from, right? So it adds to the risk of that whole business model, right? So when Charlie Munger loves Costco so much, is because of the same reason. And Professor Bakshi had given that example where Costco pays above market rates to
Because we
employees.
can't hear you. Is it only me or everyone else?
Everyone's saying they can hear.
Go ahead. Sorry about that. Yeah, go ahead.
Okay. Just one second.
Yeah, go ahead.
So my just one second. I kept my phone on because I thought you might call. So in the case of Costco, right, the way Professor Bakshi explained, he was explaining what Charlie Munger was saying, that Costco pays above market rates to employees. Costco gives lower prices to customers, right? But they pay their suppliers on time. And as they grow, even the shareholders have benefited from the growth in the business, right? And so it's a ecosystem where everybody wins, right? And you compare that with something like, let's say, Ola or Uber, right? Where they don't treat the driver partners so well, right? So time pay, credit dena, or if there's a 100 rupee bill, they will take 30, 40 and leave the driver with just 60. So things like that, right? So you can see that a lot of pain for those kind of businesses, the risks in those businesses come from the shareholders whom or the stakeholders whom they don't treat well, right? So that is so when he explained this to I really fell in love with this idea of win-win, that everybody in that ecosystem should win. That is a stable ecosystem, and so ever since then, whenever I come across these models like Avas or Akshay Kalpa, I try to sort of write more about it or think more about it. That was the
Thanks.
idea.
Yeah, thanks, Vikas. So moving on to the next question. So I think you have covered this a little bit in your session today, till now, but maybe you can give more light on this. What is your general filter in today's time as to what kind of businesses you would like to own and what kind of businesses you would try to avoid and why? If you can
Sure.
throw some light on that.
So avoid is easy, Ankit. So businesses with a lot of moving parts, I usually like to avoid.
Give me examples. Yeah.
So even before the recent fiasco, right, I found Paytm very complicated, right? I thought there were so many different moving parts within Paytm, or even Mothers and Sumi. So for example, you have so many different lines of businesses, and so I find this very complicated, right? So I like simpler businesses where the number of moving parts are just like very, very few. And it should be something that I should be able to understand easily. So for example, about a year or 6 months back, I came across this business called Radiant Cash Management System. It's a very simple business. So I thought, okay, this is something I understand. But something like Paytm, LIC for that matter, okay. So these are big, complicated businesses, I feel, where you have many different lines of businesses. And so na itna samajhne ke liye you'll have to go back 10, 20 years worth of annual reports you'll have to read and piecing it all together. These are things that I would want to avoid. Then there are things like fragile. In a way, in my opinion, it's fragile. Like airlines, I think is fragile. So I would not want to own airlines because you are dependent on one supplier, one model of the aircraft, and so on and so on. So there's like many different fragilities in that system. So I wouldn't get into that. Or businesses with a lot of debt in it. So these are things that I would like to avoid. Simpler businesses which have usually one or two lines of business and where there is some, like I explained, balance sheet is improving or cash flow is improving and so on, right? Those are the kind of businesses I want to get into.
So Vikas, that was fantastic. You mentioned about airlines being fragile. So, and earlier you mentioned that you read all the annual reports and
Yes.
all the con call transcripts. So how easy or difficult it was to then not invest knowing that it is a fragile business when you spend so much time understanding a business?
It is not easy, Ankit. So I did have that a recent example. I have written three blogs or something on Avas, and we have discussed so much in Avas. On Mission Smile, we have done a presentation on Avas, right? So for me to sell Avas was not easy. You know, I had that thing in my mind. अरे के लोग क्या सोचेंगे? Right? So consistency and commitment bias, I really suffered that. When I had to sell it, right? And my first thing was like, मैं अंकित को बताऊंगा तो अंकित क्या सोचेगा मेरे बारे में? So these are things that went through my mind when I had to sell Avas. But yeah, but looking back, I would say that so these are things that make it difficult to sell.
So as we say in life, it's the same in investing also. सबसे बड़ा रोग क्या कहेंगे लोग?
लोग.
No, so I really admire that quality of yours, that you overcome all these biases and then take a call. So that is what I admire the most about you.
I like to share one more thing, Ankit.
Yeah.
So one of the things that I'm learning, right? So I'll give you proper example. So in 2017, तब तो दो ही diagnostic companies थे. एक Thyrocare था, दूसरा Dr. Lal Path. Others were not listed yet. And So I fell in love with Thyrocare, right? Same, win-win hai, low cost hai, good for employees, good for shareholders, good for business, suppliers. There was win-win in everything. So I fell in love with that business. So the
And
mistake I made was
maybe it also had to do with the kind of promoter of the business.
promoter. Yes, yes. So there was a lot of that personality thing, right? So the mistake, the bias, I'm just trying to explain this mistake that I did was that when you like something, doesn't mean the opposite of that is bad, right? Just because this is good doesn't mean the opposite is bad, right? So I realized that Dr. Lal is also a fantastic business, right? It has a different business model, but they also have very high return on capital, return on equity, and so on, right? And they were it's also a fantastic business, and it's also growing, and they're also making investments. You could see all this. So 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 I the learning for me was don't get into this either or kind of situation, right? ये भी अच्छा हो सकता है, ये भी अच्छा हो सकता है. So if you like Avas, you can also like Aptus or Home First or others, right? It doesn't have to be an either or kind of a thing. If you like Muthoot, you can like Manappuram also. So I'm just saying that don't at least the bias that I overcame was you like one doesn't mean the other is bad.
Right, right. So, because we are coming to the end of the session,
Sure.
I have a couple of questions from my side left, but I'll jump to the questions from the audience because the audience have asked some really good questions. So somebody asked about, I'm forgetting that, but that is very important. Who asked? I'm losing it on the chat box, but he asked about your selling criteria. When do you sell? How do you sell? And do you sell it at one go, or do you take time to slowly take profit, or even in case of loss, you take it slowly? How it goes?
So Ankit, I'm work in progress there also, Ankit. I have made many mistakes there. Okay, I'll give you an example. See, I think Howard Marks said this, right? If you have not taken a 50% hit in your, if you've not seen a 50% drawdown in your stock, right? Don't call yourself an investor. Something like that he said, right? So मेरे साथ एक नहीं 3 बार हुआ है. So where I saw my stocks go down 50%. So IEX went down from 300 to 150. BSE went down from 900 to 450. Avas went down from 3000 to 1400, right? So I have seen this and it hit me in the stomach, right? If somebody has undergone something like this, you will understand what I'm saying, right? So what happened was, so when BSE went back to 900, my first reaction was to sell some of it, right? So because you don't want to make the same mistake as last time, right? And so on, right? And then after selling some, you saw it go all the way to 2500. This time it didn't stop at 900, it went all the way to 2500. So my point I'm trying to say is that if a stock gets too expensive, goes into 90 times earnings, 100 times earnings, right? I usually sell it because I think from here, see when the price becomes high, that means the expectations have also become very high, and therefore chances of disappointment are higher, right? That's why I like to buy something which is cheap because chances of disappointment is lower there. Okay, so the selling strategy I would say is like for me at least, it's work in progress. I sell when it goes into that 80 times earnings, 90 times earnings. I usually sell it.
So did you sell IEX at that time?
No, I did not.
Do you today think that you should have?
So today I know that from 300 it came to 150. So knowing that you will say no, बेचना चाहिए था तब. But if it had gone to 450, for example, just a hypothetical thing, then you would have felt like kicking yourself. So इसका कोई answer नहीं है. So I usually sell some, just a psychological thing. I sell some at a high price and then I wait. So इसके ऊपर भी गया तो I don't feel bad, नीचे भी गया तो I don't feel bad. So I sell some and it becomes very high. Just that it makes me psychologically, it allows me to, I don't feel too bad after that.
Okay. Yeah. So any other example you would want to share where maybe the stock went up to around 80 times earnings or 90 times earnings and you sold it, and then the stock went down also?
2021 May things went up and I didn't sell it. I told myself I'm a long-term investor, I'll not sell. 2022 it hit you badly. It said like base dena chahiye thoda bahut. Recently, like for example, Mac Power, I sold some at around 700, right? Because it had reached at 50, 60 times earnings, right? I sold some. So the good thing is by selling some, it allows you to, uske upar bhi gaya, so you don't feel bad because you're holding on to some others, right? Niche bhi gaya, so you don't feel bad because you feel I have sold some. It's just psychological, this one, Ankit. I'm still work in progress there. I don't have a good answer to it. I'm also trying to work around with my limitations.
No, you answered it really well, Vikas. So I'll move on to the next question. Karthik asked this question. Currently, the market is overvalued. How much cash percentage holding in your portfolio, and what is your rebalance strategy?
So keep it simple. I would say, if something goes into the expensive territory, like I said, so your definition could be different. So if you think it's gone into expensive territory, you might want to sell some of it. But at the same time, like I was able to find Repco at 6-7 times earnings, right? So if you find something like that, and if you have conviction, then buy that, right? So one is like, I don't worry so much about what market will do. I try to think more about if you find something worth investing, then I invest, provided it's cheap, it's still cheaply available. I try to buy it. And if something has gone into expensive territory, I try to sell some of it.
Got it. So Vasant asked this question. He mentions about Sridharan Anand and Nalanda. He says that Nalanda they have sold rarely, but in hindsight, he says not selling even those would have resulted in much better CAGR. So he says the principle of Nalanda has moved from being long-term holders to becoming permanent owners of businesses. I would like to know your views on this since you have read Pulak Prasad's book.
It's I don't know, Ankit. I don't know. I see Samir. What's his name? Helios Capital. Samir Arora. Right. So they've been holding HDFC Bank, I think, since IPO. Right. I don't subscribe to his views. I don't know all his views. I'm not recommending anything. But just that one thing he said, which was very apt in my view. He said that we have been holding HDFC Bank for, let's say, 30 years now. And he said, but we have been holding it 6 months at a time. That means every 6 months we would go and check our thesis if it's still valid. Are they growing? Are they this one, whatever, right? Whatever is the checklist. He said every 6 months we go and check. And every 6 months it used to pass. So we kept holding it, right? So I would say something similar that every 1 year, whatever, right? Whatever is your time frame, go and check if your thesis is still there, right? The markets at least tend to value things which have growth in them. Companies which are hungry, which are going and setting up more distribution points, which are investing in R&D, which are improving their balance sheet. So markets tend to reward these kind of companies, right? Companies like Colgate, for example, which are hardly growing, say single-digit growth, right? If you are like, let's say, a retired person, or if you are an endowment fund, right? Holding a company like that would make perfect sense because they pay you a lot of dividends and so on, right? But if you want a higher CAGR, growth rate, right? Then I think you should go into some of these other opportunities which are short term in nature, could be 4 years, 5 years kind of a thing. And then that will give you a chance to multiply your money more.
Great answer, Vikas. And of course, it's your podcast, so I don't want to take too much of time, but I would say that we should understand from their side also, when did Pulak Prasad started that fund? How big was that fund? What kind of lifestyle he had before that? And what kind of, where in your life journey you are today, and what kind of investor you are. If you are a different kind of investor and you are trying to incorporate Pulak Prasad, even though it's a fantastic strategy, it might not give you the kind of results which you are expecting, right? So know yourself is often a very
Yes,
underrated.
yes. I wanted to say the same thing, Ankit. The two most important words in investing is know thyself. Uh, uh, and second thing, Ankit, I watched a video of yours, your interview with Mr. Siddharth Mandalewala. It was a fantastic thing, and it was fantastic. I really learned a lot just watching his interview.
Thanks, Vikas. Yeah. So I'll move on to the next question. So I think Karthik asked this question. How is your risk management strategy for your portfolio when the market crashes? So I think I'll rephrase this question and make it more interesting. What were you doing during the COVID crash?
I was.
If you can give some examples, what you sold, what you bought, what you were doing. I know the answers a little bit, but
Yeah.
maybe for others it would be very interesting.
So friends, honest admission, when I had read a lot of material before, right, about crashes and so on, right? And I think Rohit also mentioned this. I thought when the crash happens, it will not affect me, right, psychologically. But to be honest with you, it affected me psychologically as well, because when it happened, my portfolio went down 50%, maybe more, right? I was invested in a special situation which just went really bad. Okay,
I think
so
Thomas Cook, right?
it was Tata Chemicals and Tata Consumer,
Tata Consumers, right?
right? So I'll tell you, I really felt very guilty about losing the notional money. It went down nearly 50% my portfolio, and at that point of time, I didn't know when I will recover that money, right? Uh, so it was very difficult. To be honest with you, it was very difficult. And people will tell you now is the time to buy. Don't think so much. And at least my mental this one, I told you I'm a quite a timid investor. So I was like uh, the same thing that 2017 May. February 10th, 2017, my mind was screaming at me, what have you done? Same thing happened to me in 2020 also. It's like, what have you done? Now what will happen? But gradually, you speak to friends and you realize everybody is in the same boat. So it makes you feel less bad, right? Like Three Idiots. So you realize your friends have also lost money, so you feel less bad about it. So you call up the friend who has lost more money than you, and you'll feel less bad about it.
So Vikas used to call me more often during those days.
We used to call each other. So my point I'm trying to say is so talking to friends actually helps you realize you're not the only one in this boat. Others also have lost. Some have lost more. Some have lost less. So then the focus should shift to buying, right? जो भी हो गया. Now you need to start focusing on what are the great buying opportunities that are there in front of you. The second mental trick which Neeraj Marathe spoke about is sometimes you may have to sell the business at a loss. Okay, that company that you bought is now trading at 50% lower. You have to sell it at a loss. So he said, don't think of it as a loss. Think of it as if that's money in an FD for you to take out, right? So sometimes you will have to sell businesses at a loss so that you can buy better businesses which are trading at a really cheap valuation, right? So these are some sort of
Give us
mental
examples, Vikas.
Huh?
Give us examples.
So I don't remember what I sold, Ankit, but I was buying. I'll tell you what all I bought. So for example, Bajaj Finance had gone down from 5,000 odd rupees to 1,800, right? And for a person like me who only saw Bajaj Finance go up, I said, this is the chance to buy. So I bought shares of Bajaj Finance. bought a lot of offhand, I don't remember. I bought Eicher Motors. So, for example, it's a great business. You saw it go 100x in your lifetime, right? So the chance to buy it is also you get it only once in a lifetime. So bought Eicher Motors as well. So
I
some
think
of these
you
businesses,
bought Eicher Motors at around 1800 or
1300.
1300. Yeah, great.
Yeah, but again, because I was a timid investor, I was buying it in lesser quantities, right? So my friend PJ, for example, is a very mild person by nature, right? Doesn't get too angry, doesn't get too excited. He's like very calm. But when it comes to buying, he's very aggressive, right? So, so he used to tell me, don't buy it with the eyedropper, buy it with bigger quantities. But I couldn't get that same conviction to do that.
Thanks, Vikas, for openly sharing everything and honestly admitting what we all go through during these crashes. Yeah. So Hetal Parik asks, I think, a couple of questions. Did you go through formal training to understand financials? As I understand, finance was not your academic background. That's a very good question, actually.
Yes, it's a very good question.
If yes, please recommend a learning interactive platform. That is one. I think because in this question, I would also like you to share a little bit about your internship with Ankur.
Yeah. So, 2, 3 things, friends. So one is, so there is a thing on Coursera. There is a thing called Introduction to Accounting. Okay, so by Professor Brian Boucher. Okay, and this video he created, this content he created in 2013. But I'll tell you, it is such a fascinating the way he taught accounting. It's a it's about a two. You can finish it in about 2, 3 weeks. Okay, and he teaches with simple examples, and it's a fantastic thing. If anybody is new to accounting, you should do this course. It used to be free. If it is paid, I will even recommend you to uh, pay and do this course. Introduction to Accounting by Professor Brian Boucher. I think Boucher is spelled as Bushe or something like that. So that is one. Then the other thing was, of course, I read Warren Buffett's letters to shareholders, right? Because there are a lot of things that he explains. Only Buffett can explain so beautifully about how he thinks about the reinsurance business, or how he thinks about investing. The great, I explained that the great, good, and the gruesome. So there are many such essays that he has written in those letters, which are like just priceless. So you will get a good understanding about businesses and how to think about opportunities and so on. The third thing was I had attended Professor Bakshi's. Now both he conducts 2 programs in Flame University. I would recommend both of them to you, right? One is on behavioral psychology, and the other is on case studies in investing. So I would recommend both of them. And I had also done an internship with Ankur Jain. So Ankur Jain is actually my junior from NDI. He also studied under Professor Bakshi, but he started his investing journey way ahead, 2004-5 or something like that. And so he conducts internships once a year now, and I would recommend that also, because so in that internship, so Ankur is like Pulak Prasad kind of investor, just a simple this one, and he likes to buy businesses which are growing and can reinvest all the profits back into the business, and which have some sort of a moat in that business, and with some great management. So so he thinks a lot about risk and downside and so on, right? And this was again in 2017, just about less than a year after I had quit, right? And so it was a great learning experience doing that internship with Ankur, because he focused on a lot of things like growth, operating leverage, and he's the kind of investor who will read cover to cover for 20 years. I'm not I'm not exaggerating. He's cover to cover. He will even read who's printed that annual report on the last page, right? So he says some of these things are, some of these patterns are very useful. So for example, he'll say, if I find a great company and I find a director in that great company, and then I'll go and find out which other company is this director, this person a director in, right? So the chances are, if he's a director in one great company, he will be a director in another great company. So he told us that at that time Piramal was a very big name, right? So and he said Piramal does business with another company called Naveen Flooring, and so he said that's how he came across Naveen Flooring, and he started studying it, right? So this is, and when you study with Ankur, for example, he will say, okay, I want to know who's Naveen, right? So that will give me some clues to the business, right? It might be something very simple, but I want to know clues. So he will go and read 20, 30 years of annual reports, cover to cover, just to find out who is Naveen. So it was a great learning experience that way, working with Ankur. Things like operating leverage, things that I did not know of, he taught us all those things in the internship. So these are some of the things I did to sort of prepare for my investing journey.
Thanks, Vikas.
Yeah, just one more thing, Ankit. Sorry. So I also used to attend Tamil Nadu Investors Association 2020, and Jatin Khemani used to conduct IIC, those events, right? So I've attended a lot of these things, and these have all added to the understanding of businesses, how some of the veterans in the industry think, and so on, right? So these have all been of great help to me.
Yeah, thanks, Vikas. So the next question she had was, do you track any investor? So this is actually a question which I was also about to ask you. Any investor whom you follow very closely, or whose vision or experience you really admire? Of course, we are all Buffett and Munger fans, apart from them.
Now, not so much, Ankit. See, I'll tell you, when I was searching for answers, right? When I started, right, I also had a lot of doubts because this whole mental map of investing is, I didn't get it at first. So there is a Buffett kind of investing. There is a Phil Fisher and Peter Lynch kind of, Phil Fisher kind of investing, Peter Lynch kind of investing. Ankur Jain is investing in a certain way. Professor Sanjay Bakshi is investing in a certain way. My friend PJ is investing in a different way. I went through a lot of these things. Like, why are they not saying the same thing, right? And so for me to understand this took me a few years, right? Saying that there are different styles of investing. If you want to invest like my friend PJ, you will have to. He's like essentially reducing errors of commission, right? And if you want to invest like Pulak Prasad, he's reducing errors of commission. So they are very different styles of investing. And it's always good to know everything, like who's doing what are the critical moving factors in each one of them. And so these kind of things are very, very useful. And so I used to follow a lot of these people earlier. Now I actually, because of lack of time, I'm not able to very closely monitor who's doing what.
Got it. So, Vikas, I'll move on to the next question. This is asked by Viraj Shah, who is, I'm assuming, who is a 22-year-old investor. He asks you for an advice. What will be your advice for a 22-year-old investor who wants to be a full-time investor?
I would say read everything that Buffett has written. That's a great starting point, right?
No, he's asking about being a full-time investor. He wants to be a full-time investor. So your thought on that?
So the question to ask, Ankit, is like, okay, where will you get the initial capital to invest, right? So in my case, I had worked for a few years, and even after I quit, my wife was still able to work, so we had some savings. So before I became an investor, right, I made sure that all my loans are paid off and I don't have any loans, any dues. I reduced my living expenses and so on, right? I still had access to. If you ask me, okay, where will you get capital to save? I knew I had some savings, and so if you're 22 years old, if you have an answer to that, then obviously that solves a lot of problems. But for people who are young but also don't have capital, then like what Professor Bakshi would say, uh, you may have to work, and on the weekends you will have to do your investing on the side, so that you're building capital, which will, matlab compound interest may, if P is zero, then everything else also goes to a zero cost, right? So P has to be substantial, and so that answer only he can provide, where the P will come from, right? But for most people, I think they will have to work just so that they can build their initial corpus.
Right, right. So I think I've covered all the important questions. I have just one last question for you, Vikas. Or if anybody has any other question, you can still type in. Because I know you are not only a writer, but also a voracious reader. So now this is the question which I ask to all my guests. Top 2-3 books that have helped you become a better investor or a better thinker. And I would again request you to please avoid mention of Buffett's letters and Munger's interview, because we all know that these are all holy grails. So, and I would say that they are indispensable as well. So what are the other texts that have inspired you?
So another way to ask this question, Ankit, could be that which are the books that you have gifted the most number of times? Right? You would have gifted it to other people because you enjoyed it so much. What books are those, right? And I think Anshul used to ask that, reframe that question and ask it that way. So I'll tell you. So one is Essentialism. So this is a book I came across in some interview. Some person, the person who said capacity to suffer, I forgot his name. Right, in that one interview, somebody asked him for a book recommendation, and he said Essentialism. And then I went and read that book, and I've read it multiple times, and I've gifted it to many friends also.
Including myself. Including myself.
Yeah. So it's a book that I would highly recommend because he says that whatever, you will obviously have to say no to a lot of things, and then you will have to say yes to only a few essential things, and then you have to make sure that you protect those things with adequate time and resources, right? For example, Ankit, I mentioned this in my blog also, that you are never late to a meeting, and whatever is important, you make sure that is ring fenced by adequate time buffers, right? So I find those kind of ideas very fascinating, right? So Essentialism is one book. Second book I would say is How to Get Lucky. Okay, so for a longest period of time, I went through life. I never appreciated the role of luck, right? Um, whereas Buffett and Munger talk so much about luck. Even Taleb talks about so much about luck, importance of luck, right? So this book, How to Get Lucky, actually gives you techniques to get lucky, right? So, for example, being on social media is a way to get lucky because that's how other people find you, right? I realized that uh, writing a blog is one way for luck to find me, right? Um, so, for example, Ankit, you mentioned at the start that I got this chance to present at Tamil Nadu Investors Association. So it just so happened that the person had read my blog, right? If I did not have a blog, then I would not have been lucky, right? So, so you have to. This book is a fantastic book. It gives you techniques on that you can implement straight away. Okay. The third book I would say is Nassim Taleb is a fantastic thinker, right? His books are not well written, but the ideas in those books are so powerful. Uh, uh, like, for example, he talks about Russian roulette. He talks about Extremistan and Mediocristan. Then he talks about convexity in anti-fragile book and so on. So there are like many different fantastic ideas that come from Taleb's books. So if you ask me for three books, I would say these are the three: Essentialism, How to Get Lucky, and Taleb's books.
Yeah. Thank you so much, Vikas. It was great having you here. Before we leave you, just it would be great if you can have a closing comment or any piece of advice for our Mission Smile community. That would be great.
So, so Ankit, so being an investor is like being a learner, right? And so if you stop being a learner, you stop being an investor, right? Warren Buffett, even at 90 odd, 92, 93, he's learning about technology companies, investing in Apple, and so on, right? So it's a great thing that we should all be learners, right? To be an investor, great investor, we have to be a great learner, right? And so back in 2015, 16, when I wanted to become an investor, full-time investor, the opportunities to this kind of platforms were just about coming, and they weren't there, right? But today, like the person just asked, I'm 22 years old and I want to become a full-time investor. He has people like you and other people who have come on this platform to look up to and ask these questions. So in a way, like I also mentioned, right? I love win-win kind of situations, right? So what you're doing, Ankit, is so great for the entire ecosystem of investors because they can come. They learn from you. They learn from people on your show. Uh, they learn from each other also, right? So you can form communities around SmartSync and learn also. So what you're doing is a great service, Ankit. So thank you so much for giving me this chance to come and share my 2 cents here.
Thank you so much, Vikas. I have no words to express now how good this session was and how enriching it was for not just me, but for everyone who was there, who were there live, and also people who will probably watch the recording. So I think somebody in the chat box wrote, will the recording will be made available? We'll try to make it available as soon as possible. We'll update you about that. Of course, it is getting recorded. And with this, I just want to thank Vikas once again, and also to all of you who have been very patiently listening to Vikas and asking some really good questions. So thank you so much, Vikas, and wish you all
Thank you.
the best in your investing journey.
Thank you, Ankit. Thank you.
Thank you, everyone. Bye.